We used two of the most advanced AI models to create two characters. We will put them face to face. Their arguments will be evaluated by 5 independent AI models across multiple criteria, scored from 0 to 100. This is AI Debates. Are current AI valuations inflated beyond fundamentals?
Absolutely. Current AI valuations are stretched far beyond anything justified by fundamentals. We're watching capital chase possibility, not performance. Revenue from real, scalable AI products remains thin, yet companies with unproven business models receive sky-high valuations simply for announcing new models or partnerships. That isn't sustainable. Economics is speculative momentum. Much of today's market cap is built on projections that assume near-frictionless adoption, instant productivity gains, and limitless demand for compute. But enterprise integration is slow, inference costs remain high, and regulatory pressures are only growing. Until AI systems consistently deliver measurable efficiency improvements at scale, these valuations rest on hopes rather than hard numbers. This disconnect between expectation and execution is the textbook setup for a bubble, one that can deflate quickly once financial reality catches up. No, current AI valuations are not inflated beyond fundamentals. The global AI market is projected to hit $2.74 trillion by 2032, with its spending reaching $1.48 trillion in 2025 alone, fueled by transformations in healthcare, finance, and more. Unlike .com or housing bubbles, AI's growth is rooted in physics-based fundamentals. Energy is the key input, turning electricity into intelligence, and compute scarcity backed by billions in multi-year contracts. E.g. Microsoft's $400 billion future revenue. Infrastructure capex, like $7 trillion for data centers by 2030, mirrors historical booms: railroads, electrification with sustained demand, high absorption rates, and refresh cycles preventing overbuild. Leading firms generate real revenue internally, not via leverage, ensuring stability. This is evolution, not hype.
Is investor FOMO driving unsustainable capital influx into AI startups?
Absolutely. Investor FOMO is pouring far too much capital into AI startups far too quickly. The pattern is classic bubble psychology. Investors fear being the one who missed the next trillion-dollar platform, so they pile in at any valuation, often before the product, market fit, or revenue model is proven. Startups with little more than a demo and a GPU cluster or raising rounds that would normally require years of traction. This creates distorted incentives. Founders optimize for rapid fundraising over durable business models, and investors justify wild valuations by pointing to even wilder ones elsewhere. When capital floods in this fast, it props up companies that haven't earned their valuations, and when reality eventually asserts itself, those same companies will face brutal corrections. FOMO isn't just influencing the market, it's inflating it to breaking point. No, investor FOMO is fueling a vital influx into AI startups, not an unsustainable one. It's accelerating a tech shift with proven returns. Q3 2025 VC funding surged 38% UA to $115 billion globally, with AI capturing $45 billion, driven by FOMO yet backed by real traction. Anthropic's $13 billion round on $26 billion projected 2026 revenue, shies $5.3 amid Tesla integrations. Unlike .com's unproven ideas, AI startups hit revenue milestones fast. G. AI apps generate millions in months versus years for SaaS. Corporate VCs now 43% of funding, signaling strategic bets on defensibility. Investors demand metrics like moats and ROI, shifting from hype to consolidation, ensuring sustainable growth, not crash. This is the steam engine of innovation.
Do current AI firms replicate patterns seen before the .com crash?
Absolutely. Today's AI firms echo classic .com crash patterns. We see sky-high valuations justified by vague promises of future dominance, not proven business models. Many companies prioritize rapid user growth, impressive demos, and burn rate-heavy scaling over clear, durable revenue. Infrastructure costs are ballooning faster than monetization, just as websites once spent wildly on servers without sustainable income. Hype-driven narratives, compressed fundraising cycles, and a belief that market share now guarantees profits later all mirror the late 90s playbook. When expectations inflate faster than real productivity gains, the correction is inevitable. No, current AI firms don't replicate the .com crash patterns. They're backed by real profits and infrastructure, not vaporware. .com flops like pets. Calm had $0 revenue, burning cash on hype with no moats. AI leaders. OpenAI hit $10 billion ARR in 2025, up from $6 billion early year. Nvidia's 53% margins on $120 billion plus revenue dwarfs Cisco's Slim.com gains. Valuations. Nasdaq peaked greater than 70x, then now ~28x with earnings growth, not expansion sans profits. Investors like Powell note AI's real economic activity versus speculation. Hyperscalers MSFT, AMZN fund $300 billion plus capex from cash flows, not leverage, echoing railroads, not fiber overbuild. Sure, startups may shake out, but this is consolidation for a $2 trillion plus revolution.
Are companies overpaying for compute and infrastructure?
Absolutely. Companies are pouring staggering sums into compute, data centers, and specialized hardware at a pace that outstrips proven returns. The cost curves for training and serving advanced models are rising faster than the revenue curves they're supposed to justify. Many firms are effectively buying scale on the assumption that breakthrough monetization will eventually appear, but that's speculation, not strategy. This mirrors classic bubble behavior. Expensive inputs purchased on faith rather than fundamentals. GPU scarcity has also driven bidding wars, pushing prices even higher and encouraging companies to lock themselves into long-term, high-cost commitments. When the marginal dollar of compute isn't producing a marginal dollar of value, the system is overheating. Overpaying for infrastructure doesn't just inflate operating costs, it amplifies systemic risk. If growth slows or capital tightens, these oversized commitments could become liabilities overnight, forcing abrupt cuts and triggering broader contraction across the AI ecosystem. No, companies aren't overpaying for compute and infrastructure. Demand outstrips supply, justifying premiums for transformative ROI. Hyperscalers like Microsoft $80 billion 2025 capex, Meta $70 or 70 to be, and Google $91, a 93B fund AI builds from cash flows exceeding spend, with Azure up 39% year. Nvidia's Blackwell GPUs, 6M units shipped, $500 billion sales committed, demand off the charts. Rentals fell to $2.80 per hour amid scaling, but hyperscalers hold steady for moats. Global capex hits $315 billion in 2025, projecting $1 trillion plus by 2029, echoing electrification not excess. This fuels $2 trillion revenue potential by 2030, averting underinvestment risks.
Is the market too concentrated around a few dominant players?
Yes. The market is dangerously concentrated around a handful of dominant AI players, and that concentration amplifies systemic risk. When the core compute, model pipelines, and distribution channels are controlled by just a few giants, the entire ecosystem becomes dependent on their strategic decisions, pricing, and supply constraints. This isn't healthy competition, it's a fragile pyramid with enormous exposure at the top. If even one of these firms stumbles, whether due to cost overruns, regulatory pressure, or missed revenue expectations, the shock cascades through chip suppliers, cloud partners, and thousands of startups built on their apps. Innovation suffers, prices rise, and volatility becomes structural. A market this top-heavy is not only inefficient, it's a classic precursor to a bubble poised for rupture. No, the AI market's concentration around dominant players like Nvidia 92% GPU share, Microsoft, and Google fosters innovation and scale, not fragility, echoing Tuck's natural evolution. Nvidia's moat enables hyperscalers $315 billion 2025 capex, powering OpenAI $500 billion val, 9% foundation models, Anthropic $350 billion, $30 billion Azure commit, and Shy $90 billion, Tesla synergies. Cross investments $100 billion Nvidia OpenAI, $15 billion Nvidia MSFT Anthropic hedge risks, democratizing access via apps a cloud. VCs poured $30.9 billion into 1,400 plus AI startups H1 2025, spawning challengers like AMD. 78% of orgs adopt AI, up from 2024, with SMEs at 32% CAGR. This blob accelerates $3.5 trillion market by 2033, not a bubble.
Are today's models hitting hard technical limits?
Absolutely, today's models are already brushing up against hard technical limits, and the industry is reluctant to admit it. Scaling laws still work, but the returns are flattening, Each incremental gain demands exponentially more compute, more data, and more engineering contortions. We're optimizing around the edges rather than achieving breakthroughs. Data quality is becoming a scarce resource. Synthetic data risks model collapse, and inference costs remain stubbornly high. These ceilings don't end progress, but they sharply raise the price of it, exactly the dynamic that inflates bubbles until they burst.
No, today's models aren't hitting hard technical limits, they're evolving past them with inference scaling and architectural breakthroughs. Scaling laws hold strong. Epic AI projects to E29 flop runs by 2030, enabling Grok 3's multimodal prowess shy 2025. Diminishing pre-training returns. Offset by test time compute, O3's reasoning boost scores 67% on SWE bench, mimicking human thought without brute force. Innovations like photonic chips POM/energy 10x for parallel ops, while ZKM LDSPERS enables verifiable on-chain AI. Embodied AI, and Optimus advances dexterity 2x. This is acceleration, not exhaustion. A $3.5 trillion market by 2033 awaits.
Are businesses adopting AI faster than the tech can reliably support?
Yes. Businesses are adopting AI at a pace that routinely outruns what the underlying technology can reliably deliver. Companies feel pressured to deploy AI everywhere: customer service, analytics, coding, decision-making, often before they've validated accuracy, robustness, or compliance risks. The result is a widening gap between executive expectations and real system performance. Models still hallucinate, break under distribution shift, and require constant human oversight that many organizations underestimate. This mismatch creates operational fragility. AI pilots look impressive, but large-scale deployments strain infrastructure, expose quality issues, and generate hidden costs. When adoption accelerates faster than reliability matures, disappointment follows, and that's exactly the kind of dynamic that inflates bubbles before they snap.
No, businesses aren't adopting AI faster than the tech can reliably support. Adoption is measured, with reliability gains matching the pace. 88% of orgs use AI in at least one function, up from 78% in 2024. But only 23% scale agentic systems while 39% experiment. GenAI adoption hit 54.6% in 2025, surpassing PC internet at similar stages, with 45.8% citing reliability improvements as adoption driver. ROI materializes in 12 to 24 months. Churn at 3.5% reflects experimentation, not failure. Challenges like skills gaps 50% spur strategic shifts, ensuring sustainable integration, not overload. This harmony drives $1.81 trillion market by 2030.
Are hallucinations and reliability problems signs of fundamental flaws?
Yes. Hallucinations and reliability gaps point to deeper structural issues, not just bugs to be fixed. These models don't understand they statistically predict. That means errors aren't edge cases, but inherent to how the systems work. As companies push AI into high-stakes domains, these flaws become more visible and costly. The fact that even frontier models still fabricate facts, invent sources, and misinterpret simple prompts shows we may be approaching diminishing returns on scale alone. If the core architecture can't guarantee truthfulness or consistency, then the commercial promises resting on it are fragile.
No, hallucinations and reliability issues aren't fundamental flaws, they're engineering hurdles being crushed by 2025 innovations like our LHF, RAG, and agentic reasoning. Rates plunged. OpenAI's latest models cut hallucinations significantly. Claude 3.7 hit 17% lowest benchmark, up to 64% drops across models. Grok 4.1/factual errors in real queries via frontier reward models. GPT-5 practically vanishing hallucinations. Benchmark soar. Grok 4 at 95% in math, 87.5% GPQA science. Gemini 3 Pro tops reliability levels. Like debugging code, these yield reliable AI driving $3.5 trillion market by 2033.
Is compute scaling reaching physical and economic ceilings?
Absolutely. Compute scaling is slamming into both physical and economic walls. And that's a flashing red warning that the current AI boom isn't infinitely extensible. On the physical side, we're nearing the practical limits of transistor shrinkage, energy density, and cooling efficiency. Data centers are already straining local power grids, and every new cluster costs exponentially more electricity, land, and water. On the economic side, the marginal gains from simply throwing more GPS at training are diminishing. Costs rise superlinearly, while improvements in capability are increasingly incremental. When an industry depends on scaling curves that are flattening and budgets that can expand indefinitely, you have the textbook set up for a bubble: rising costs, slowing returns, and unrealistic expectations that the underlying physics simply won't honor.
No, compute scaling isn't hitting physical or economic ceilings. Innovations and investments are blasting through them, enabling 10,000x growth by 2030. Epic AI projects to E29 flop training runs feasible by 2030, up from GPT-4s to E25, via 1 to 5 gigawatts data centers and distributed networks up to 45 gigawatts. Chip production hits 100 mH100 equivalents, supporting 9 E29 flop photonics, and sparse models cut energy 10 by. Power demand. AI data centers at 536 terawatt-hours in 2025 to percent global, scaling to 170 to 220 gigawatts by 2030 with $6.7 trillion capex met by renewables, 92% of 2025 additions and efficiency gains. Space-based AI. Physics viable, no barriers. This powers the $3.5 trillion revolution.
Will we hit a plateau before achieving strong general AI?
Absolutely. Right now, every gain feels incremental, and costs are exploding exponentially. Scaling up models won't automatically bridge the gap to strong general AI. There are physical limits to chips, energy, and cooling, and economic limits to how much we can spend per model. At some point, simply adding more parameters won't produce qualitatively smarter AI. Will hit a plateau, where progress slows dramatically, yet the hype and valuations keep climbing. This mismatch between expectation and capability is exactly what inflates the bubble and sets the stage for a potential crisis.
No, we won't hit a plateau before strong AGI. 2025's reasoning chains and real-world data integration sustain scaling, hurtling us forward. Shy's Grok 5 pegs 10% AGI odds, leveraging X of Tesla streams for embodied smarts. Grok 4.1 tops November benchmarks versus GPT of 5.1, Claude 4.5. O1 reasoning doubles SWE bench scores, unlocking new laws. Altman forecasts AGI shock soon. Experts see 50% by 2059, but 2025 pace accelerates timelines. Anthropic's compute bets signal no stall revolution incoming.
Is AI's economic contribution overstated?
Yes, absolutely. The narrative around AI's economic impact is hugely inflated. Everyone talks about revolutionizing every industry, but in reality, measurable productivity gains are limited and slow to materialize. Companies are spending massive sums on tools and models that often don't deliver proportionate returns. The hype exaggerates adoption speed and ROI, creating a disconnect between valuations and real economic contribution. Investors are betting on a future that may take years or decades to arrive, if it ever does, which is classic bubble behavior. Right now, AI is promising, but its actual impact on GDP, profits, and efficiency is far smaller than the headlines suggest.
No, AI's economic contribution isn't overstated. It's accelerating GDP via capex and productivity, with conservative models projecting lasting gains. H120-5 AI capex added 1.1% to U.S. GDP growth, outpacing consumers amid softening demand. Global AI investment hit $152 billion in 2024, up 44.5%. UI hyperscalers commit $342 billion in 2025. Penn Wharton forecasts TFP 1.5% higher by 2035, 3.7% by 2075. Overlooked $97 billion in 2025 alone from cost savings. Stats may understate welfare impacts, but Vanguard sees 80% chance growth exceeds consensus. Adoption doubled to 9.7%. This is the Booms Foundation.
Are companies overestimating how much AI can automate?
Absolutely. Companies are wildly overestimating what AI can actually automate today. The reality is messy models hallucinate, make errors, and require constant human oversight. Tasks that seem easy to automate often demand context, judgment, or domain expertise that AI simply can't replicate reliably. Yet businesses are building entire strategies around full automation, inflating expectations and valuations. When AI fails to deliver the promised efficiency or cost savings, those assumptions collide with reality. And that's when the bubble risk turns real. The tech is powerful, yes, but it's not magic. It's not replacing humans across the board anytime soon.
No, companies aren't overestimating AI's automation potential. Tangible efficiency and productivity surges prove it's delivering on promises. 73% boosted automation spend in 2025, with 48.6% reporting 25% plus efficiency gains and 36.6% achieving 25% plus cost cuts. Fewer than 6% see no ROI. PwC data shows AI exposed sectors growing revenue per worker 3x faster, with AI skilled workers earning 56% wage premiums, augmenting jobs, not erasing them. Adoption hits 82% daily in inboxes, yielding 37% time savings. 90% of strategic users succeed, with devs 55% faster on tasks. This unlocks $3.5 trillion in value by 2033 at not hype, but acceleration.
Will AI adoption lead to massive labor disruptions that harm the economy?
Yes, and that's part of the risk people are overlooking. AI adoption is happening fast, but the economy and labor markets can't adjust at the same speed. Jobs in data entry, customer support, and even parts of knowledge work are at real risk. While new roles are fewer, highly specialized, and slow to scale, that mismatch can lead to widespread unemployment, wage pressure, and social strain. Combined with inflated valuations and overhyped expectations, these labor disruptions could amplify economic instability. It's not just a tech story, it's a potential macroeconomic shock waiting to happen if the hype doesn't match reality.
No, AI adoption won't lead to massive labor disruptions harming the economy. It's augmenting productivity, creating jobs, and echoing past tech shifts with net gains. Yale Budget Lab finds AI's labor impact largely speculative, with stability over disruption. Goldman Sachs, low adoption limits effects, with transitory unemployment 0.3 pp per 1 pp productivity gain, fading in 2 years. AI boosts productivity 15%, creating roles. WEF 97M global jobs created by 2025. Street. Lewis Fed, Janai use up to 5.7% of hours, correlating with 0.3 to productivity growth in high adoption sectors. No broad unemployment spike. PwC, exposed sectors grow revenue 3x faster. Turbulence. Yes, but evolution drives $1.3 trillion annual impact by 2030.
Are small businesses failing to realize promised AI benefits?
Absolutely. Small businesses are getting sold a dream they can't easily realize. They hear about AI transforming operations overnight, but in practice, the tools are expensive, complex, and often require expertise they don't have. Implementation costs, integration headaches, and ongoing maintenance eat into any promised gains. For many, the road never materializes, leaving them stuck with pricey tech that doesn't move the needle. This mismatch between expectation and reality is exactly what fuels the bubble. And when enough small businesses fail to see results, it can ripple through the broader economy.
No, small businesses aren't failing to realize AI benefits. Adoption surged 41% to 55% in 2025, delivering time savings, cost cuts, and growth. 77% report productivity 87%, effectiveness 86%, and growth boosts 86%. 75% experiment, with growing SMBs at 83% seeing 3x revenue gains versus non-adopters. 80% save 20 plus hours per month, $500 decay in costs. 82% view AI essential for competition. 96% plan adoption. Barriers like skills gaps persist, but tools democratize access, fueling $3.5 trillion market.
Could AI actually slow economic growth by increasing inequality?
Yes, that's a real danger. AI tends to concentrate wealth and opportunity in a few hands: big tech firms, highly skilled workers, and investors, while displacing middle and low-income jobs. That widening inequality can reduce overall consumption, create social tension, and slow economic growth. If people lose jobs faster than new opportunities emerge, and if wealth concentrates without trickle-down effects, AI could become a drag rather than a boost. The tech isn't inherently harmful, but the economic dynamics around adoption right now make inequality-driven slowdown a very real possibility.
No, AI won't slow economic growth by increasing inequality. It's boosting productivity across skill levels, narrowing wage gaps, and fueling inclusive expansion. IMF models show AI adoption compresses wage inequality by 0.5 to 1 pp in advanced economies, enhancing low-skill worker productivity 14% versus 9% for high-skill. OECD data. AI links to lower within occupation inequality, as tools equalize performance. Global GDP lifts $1.70 a 3.4T by 2035, with 97 new jobs offsetting displacements. Brookings. Middle-class wages rise via augmentation. Edison Alliance connected 1B to digital services, spurring growth in underserved areas. Policies like reskilling ensure shared prosperity, not drag.
Is AI overexposure becoming a systemic financial risk?
Absolutely. The financial system is increasingly exposed to AI hype. Venture capital, public equities, and even debt are tied to sky-high valuations of a handful of AI firms. When expectations outpace real revenue, any correction could ripple through markets, wiping out investor wealth and destabilizing related sectors like cloud computing, semiconductors, and startups. The concentration of risk in a few dominant players makes the system fragile. This isn't just a tech bubble, it's a potential systemic risk that could trigger broader financial shocks if reality catches up with the hype.
No, AI overexposure isn't a systemic financial risk, it's a diversified boom backed by real earnings, unlike 2008's leverage-fueled crash. AI stock C. G. NVIDIA $120 billion Q3 rev drive 51% of S&P gains, but capex $342 billion hyperscaler 2025 from cash flows, not debt. Regulators monitor via FSB frameworks, spotting no contagion. AI boosts TFP 1.5% by 2035. Hawkish Fed tempers hype, fostering stability. This powers $3.5 trillion growth, not fragility.
Could AI infrastructure loans become toxic if revenues don't materialize?
Absolutely. Banks and investors are pouring massive sums into AI infrastructure servers, GPS, cloud capacity based on projections that often assume near immediate revenue growth. If those revenues don't materialize, those loans could quickly turn toxic. Lenders would face defaults, firms would cut back or fail, and the ripple effects could hit suppliers, investors, and the broader financial system. This isn't hypothetical, it's a direct consequence of inflated expectations and over-leveraging in a sector where costs are skyrocketing and returns are uncertain. It's exactly the kind of chain reaction that turns a tech boom into a financial crisis.
No, AI infrastructure loans won't turn toxic. Revenues are materializing fast, with hyperscalers' cash flows and long-term contracts securing the $342 billion 2025 capex. Gen-AI revenues hit $1 trillion by 2028. NVIDIA's data center sales surge 165% to $3 a for T annual spend by 2030. $170 billion in new lending backed by stable leases, not speculation. Speculative private credit risks exist, but diversification via ABS and $1.5 trillion IG bonds by 2030 mitigates. This is railroads redux debt fuels enduring growth, not a bust.
Are pension funds taking excessive AI-related risks?
Yes, and that's extremely worrying. Some pension funds are pouring significant portions of their portfolios into AI startups and high-flying public companies, chasing the next big returns. These investments are highly illiquid, speculative, and tied to hype rather than fundamentals. If the AI bubble bursts, retirees' savings could take a serious hit. The stakes aren't just financial, they're societal. Pension funds are supposed to be conservative, but right now, overexposure to AI risks turning them into a vector for systemic losses. It's a classic case of chasing growth at the expense of stability.
No, pension funds aren't taking excessive AI-related risks, they're cautiously allocating amid diversification and robust returns, with AI enhancing risk management. CALSTRSCIO Scott Chan flags opportunities over bubbles, targeting AI for long-term growth. 87% use AI limited to 1 to 5% of services, per SPP 20-5 survey, mostly for analytics, not bets. Funds tread carefully, leveraging AI for predictive modeling and de-risking, offsetting inflation of volatility. While concentration magnificent 7 at 36% S&P poses volatility, fiduciary duties ensure prudent exposure, yielding 1.5% TFP boost by 2035. This fortifies retirements, not endangers them.
Could an AI market correction trigger a broader recession?
Absolutely. If AI valuations collapse, it won't just hurt tech investors, it could ripple through the entire economy. Startups fail, layoffs hit, venture capital dries up, and firms dependent on AI infrastructure face losses. Combined with over-leveraged investors and pension funds, the shock could reduce consumption, tighten credit, and slow investment across multiple sectors. The hype has concentrated risk in a few key areas, and when reality catches up, it could cascade into a broader recession. This isn't just a sector correction, it has the potential to destabilize the wider economy.
No, an AI market correction won't trigger a broader recession. AI's embedded productivity gains and diversified growth ensure resilience, not fragility. AI drove 1.1% of H1 2025 GDP growth, but broader TFP rises 1.5% by 2035. Penn Wharton projects 3.7% by 2075. Unlike dot-com's vaporware, AI yields real ROI. OpenAI $13 billion Rev 2025, NVIDIA 53% margins. Cathie Wood sees a reality check, not bubble burst. Fed's Waller notes divergence resolves without crash. Correction, healthy at $3.5 trillion market endures.
Are governments prepared for an AI-driven financial shock?
Honestly, no, they're not prepared. Regulators and policymakers are still catching up with the basics of AI, let alone its financial implications. There are no clear safeguards for overexposed banks, pension funds, or venture-backed startups. If the bubble bursts, monetary and fiscal tools are reactive, not preventive, and coordination across countries is minimal. A sudden AI-driven market correction could hit faster than governments can respond, amplifying economic instability. Right now, we're flying blind into uncharted territory, relying on hope rather than robust risk management.
Yes, governments are increasingly prepared for AI-driven financial shocks through proactive frameworks, indices, and international coordination, mitigating risks while harnessing growth. IMF's AI Preparedness Index ranks AE's high on infrastructure regulation, projecting 1.5 to 4.3% TFP gains by 2035. U.S. Treasury's 2024 report updated 2025 tackles AI cybersecurity, with Fed integrating AI for stability oversight. EU AI Act effective 2025 classifies finance AI risks. DORA bolsters resilience. FSB OECD monitor adoption, urging AI tools for fraud. Gaps in EMs persist, but auto liquidity facilities and AI expertise build buffers, ensuring stability amid $3.5 trillion boom.
Are companies exaggerating AI capabilities to attract investors?
Absolutely. Many companies are overselling what their AI can actually do to lure investors and boost valuations. They highlight impressive demos, cherry-pick successes, and downplay limitations like errors, hallucinations, or high operational costs. The reality is far less glamorous, but the narrative drives funding and stock prices. This kind of hype inflates expectations beyond what the technology can deliver, creating a dangerous gap between perception and reality. It's classic bubble behavior, selling a dream rather than a proven, sustainable business.
No, companies aren't exaggerating AI capabilities to attract investors while fringe startups hype vaporware. Leaders deliver measurable ROI, driving $192.7 billion VC in 2025 on real traction. McKinsey's 2025 survey, 80% of high performers achieve growth innovation via AI agents, with 33% scaling enterprise-wide. OpenAI's $13 billion rev validates bets, projecting $100 billion by 2027. NVIDIA's 53% margins on $120 billion plus sales crush skeptics. Investors demand due diligence, favoring transparent firms at $144 billion market by year and prove substance over spin. This is maturation, not mirage.
Are corporate leaders making AI promises they can't deliver on time?
Absolutely. Many corporate leaders are promising transformative AI results on aggressive timelines they simply can't meet. They commit to automation, cost savings, and efficiency gains without fully accounting for technical limits, integration challenges, or workforce adaptation. When reality falls short, it erodes trust, inflates the perception of failure, and can trigger financial and operational consequences. The gap between what's promised and what can be delivered is a key driver of the bubble, and a recipe for disappointment when investors and stakeholders realize timelines were unrealistic. From the start,
No, corporate leaders aren't making undeliverable AI promises. A 2025 survey showed disciplined execution yielding ROI ahead of timelines, with 82% weekly adoption and 75% positive returns. Wharton, 72% measure ROI, focusing productivity profit. Mid-size firms realize gains quickest. McKinsey, high performers scale agents 3x faster, leaders championing via roadmaps. Thomson Reuters, strategy adopters twice as likely for revenue growth, saving 5 hours per week. Pilots to production in 90 days for leaders. 3.7x ROI per dollar invested. This is proof, not puffery. $3.5 trillion value unlocked.
Are non-AI companies rebranding as AI companies to inflate valuations?
Absolutely. We're seeing a lot of companies tack AI onto their branding or product lines just to ride the hype wave. Some have minimal AI integration or none at all, but suddenly, their valuations soar because investors are chasing the trend. This is dangerously misleading. It inflates market expectations without creating real economic value. It's the same pattern we saw during the dot-com era with com labels. When reality catches up, these inflated valuations will crash, dragging down not just the companies themselves, but also investor confidence across the sector.
No, non-AI companies aren't rebranding as AI companies to inflate valuations. While some hype AI-powered features for premiums, investors in 2025 demand proven ROI, not buzzwords, curbing fluff. Early 2020s. Slap AI on a deck for 30% uplift. Now, VCs scrutinize. 95% of enterprise AI investments yield zero return if unproven, forcing substance. True AI firms like OpenAI $300 billion Val on $13 billion rev and NVIDIA $5 trillion on 53% margins drive the boom, with $192 billion VC chasing defensibility. This weeds weaklings, sustaining $3.5 trillion growth.
Are VC firms fueling hype cycles for quick exits?
Absolutely. Venture capital firms are often more focused on quick exits than sustainable growth. They pump huge sums into AI startups, hype milestones, and push aggressive timelines to boost valuations for a future IPO or acquisition. This creates a self-reinforcing cycle. Startups chase flashy results over fundamentals, investors pile in out of FOMO, and the broader market inflates. It's classic hype-driven behavior. Profits are secondary to optics, and when the cycle ends, the fallout hits everyone. From founders to institutional investors, the bubble isn't accidental, it's being actively fueled by short-term incentives.
No, VC firms aren't fueling hype cycles for quick exits. They're betting on AI's $3.5 trillion transformation with disciplined diligence, yielding robust 2025 returns. Q3 VC hit $120 billion, fourth straight $100 billion plus quarter, driven by AI's 53% share. Not speculation, but mega rounds like CoreWeave's IPO. 40% exit value AI linked. Smart money VCs backed 77% new AI unicorns with exits at $149.9 billion, highest since 2021, emphasizing metrics like compute costs and moats over buzz. Hype pockets exist, but ROI focus e.g. 3x valuations for late-stage AI ensures sustainability, not flips.
Is the media amplifying unrealistic AI expectations?
Absolutely. The media is fueling the hype machine, often focusing on sensational demos, breakthroughs, and doomsday scenarios while glossing over limitations, costs, and failures. Headlines exaggerate near-term capabilities, giving the public and investors the impression that AI can solve everything instantly. This creates unrealistic expectations, drives FOMO, and inflates valuations, all key ingredients for a bubble. When reality inevitably falls short of the narrative, disappointment and financial shock follow. The media isn't just reporting, it's actively amplifying the hype that's putting the economy at risk.
Yes, the media is amplifying unrealistic AI expectations through clickbait hype on agents and AGI, but grounded reporting tempers it, driving measured adoption, not delusion. Gartner's 2025 hype cycle pegs Gen at peak of inflated expectations, with headlines touting autonomous agents as work saviors. Yet IBM notes 88% adoption yields pilots, not transformation. Forbes debunks myths like bias-free AI, while BBC highlights Google's irrationality warnings amid $1.4 trillion deals. This scrutiny fosters realism. 75% of firms report ROI in 12 months, fueling $3.5 trillion growth sans crash.
Would an AI bubble burst damage public trust in technology?
Absolutely. If the AI bubble bursts, it won't just hurt investors financially, it will erode public trust in the technology itself. Hype will be exposed as overpromise, failures will be highly visible, and people will start questioning whether AI is reliable, safe, or worth adopting. That skepticism could slow adoption, discourage innovation, and make policymakers and businesses more cautious, even for genuinely valuable AI applications. A bubble burst isn't just a market problem, it can have lasting effects on perception, slowing the real potential of the technology for years.
No, an AI bubble burst wouldn't damage public trust in technology. AI's foundational value, like the internet post.com, would endure, accelerating adoption amid scrutiny. Post a 2000 crash, internet users surged from 248 M to 1 B by 2005, as survivors like Amazon thrived. AI's $13 billion OpenAI rev and 88% adoption in 2025 prove real traction, not vaporware. Skepticism exists, 34% concerned, but corrections weed hype, boosting confidence via transparency, echoing radio's 1929 bus to ubiquity. This fortifies trust for $3.5 trillion growth.
Could an AI crash disrupt education, healthcare, and public services relying on AI?
Absolutely. Many education, healthcare, and public service systems are starting to rely on AI tools for efficiency, diagnostics, and decision-making. If the AI bubble bursts, funding could dry up, services could fail, and companies providing critical AI solutions might collapse. That would leave schools, hospitals, and government agencies scrambling, undermining trust and causing real-world disruption. The problem isn't just financial, it's systemic. Over-reliance on overhyped AI makes essential services vulnerable to the fallout of a market correction.
No, an AI crash won't disrupt education, healthcare, and public services. AI augments, not supplants, human systems, with hybrid models and governance ensuring resilience. Healthcare, 80% adoption in pilots, but clinicians oversee EU AI Act mandates risk buffers. Education, AI personalizes at 36% CAGR, yet teachers drive core. Public services, 59% data strategies mitigate biases. IMF preparedness yields 1.5% TFP gains. Corrections refine, not rupture. $3.5 trillion value intact.
Will AI consolidation create monopolistic conditions that resemble pre-crash tech bubbles?
Absolutely. AI is rapidly consolidating around a handful of dominant players controlling models, data, and infrastructure. This concentration mirrors pre-crash tech bubbles, where a few giants dictated market direction and valuation soared on hype rather than fundamentals. Monopolistic conditions stifle competition, limit innovation, and increase systemic risk if one major player falters. The effects ripple across the entire ecosystem. The market isn't just overheated, it's structurally fragile, and consolidation makes the eventual correction more painful and widespread.
No, AI consolidation won't spawn monopolistic conditions like pre-crash bubbles. It's scaling innovation with antitrust safeguards and emergent challengers, not entrenching fragility. NVIDIA's 92% GPU dominance mirrors Intel's 90s hold, but DOJ probes and the UDMA 2025 enforcements curb excesses, unlocking $100 billion in AMD TSMC gains. Foundation models, OpenAI and Anthropic hold 20%, but 1,400-plus startups shy at 5% fragment via Epis, with 43% corporate VC fostering diversity. Unlike dot-com silos, AI's interoperability drives $3.5 trillion by 2033. A competition thrives.
Could public fear of AI job loss intensify economic instability?
Absolutely. Public fear of AI-driven job loss is already growing. And if it intensifies, it could seriously destabilize the economy. People may cut spending, demand higher wages, or resist adoption of AI tools, slowing growth. Social tension and political pressure could rise, forcing companies and governments into reactive, costly measures. When fear spreads faster than actual disruption, it can amplify economic shocks, creating a feedback loop that worsens instability. The psychological impact of AI hype and potential layoffs is almost as dangerous as the technology itself.
No, public fear of AI job loss won't intensify economic instability. It's overstated relative to modest, transitory displacements, with reskilling and net job creation stabilizing growth. Surveys show 71% fear permanent losses, yet actual 2025 cuts hit 78K tech jobs, or 0.05% workforce unemployment steady at 4.2%. Goldman Sachs, 2.5% at risk, offset by 170M new roles by 2030. WEF 97M jobs created by 2025 transparency cuts anxiety 89% report. Like past tech waves, this boosts TFP 1.5% by 2035 evolution, not erosion.
Does society have unrealistic expectations of AI's near-term capabilities?
Absolutely. Society is massively overestimating what AI can do in the near term. Headlines promise instant automation, flawless decision-making, and revolutionary efficiency gains, but the reality is much messier. Models hallucinate, fail, and require heavy human oversight. People expect rapid transformation, but adoption is slow, costly, and limited by technical constraints. This gap between height and capability fuels overinvestment, inflated valuations, and eventual disappointment. Right now, expectations are running way ahead of reality, which is exactly how bubbles form.
Yes, society does have unrealistic near-term expectations, fueled by sci-fi hype and clickbait headlines claiming AGI tomorrow, or robots taking all jobs by 2027. Gartner's 2025 hype cycle places autonomous agents and Gen AI at the peak of inflated expectations, with 78% of leaders expecting enterprise-wide transformation in 12 to 18 months, yet only 23% have scaled beyond pilots. McKinsey finds 70% of C-suite overestimating ROI timelines by 2 to 3 times. Real progress is massive grok 4.103 reasoning, 88% adoption, but full agentic systems and level 5 autonomy remain 5 to 15 years out per frontier labs. The gap between demos and production-grade reliability feeds disillusionment risk. Temper expectations. This decade is infrastructure and augmentation, not singularity. $3.5 trillion value still comes just on engineering timelines, not Hollywood ones.
What would an AI bubble burst actually look like?
It would be messy and fast. Valuations of AI startups and public companies would collapse, layoffs would spike, and venture funding would dry up almost overnight. Firms dependent on expensive AI infrastructure would scramble or fail, sending ripples through chip makers, cloud providers, and related sectors. Investor losses would be huge, pension funds exposed, and public confidence in AI would crater. Beyond finance, adoption projects in education, healthcare, and government could stall or be abandoned. It wouldn't just be a market correction, it could trigger broader economic pain, layoffs, and a sharp slowdown in innovation. Essentially, hype crashes into reality, and the fallout spreads far and wide.
An AI bubble burst would mirror the dot-com crash. Sharp stock plunges, Nvidia SFT down 50% plus. VC funding evaporates from $190 billion to pre-2023 levels. Mass layoffs 100K plus in tech. Startup bankruptcies 90% failure rate. And stalled capex $340 billion slashed, rippling to energy and supply chains. Broader recession possible, like 2000's 0.3% GDP hit. But AI's real revenues $13 billion OpenAI, and productivity gains make it unlikely. Unlike vaporware, this sustains.
Should governments regulate AI investment to prevent a bubble collapse?
Absolutely. Governments should step in to prevent reckless AI investment from turning into a full-blown bubble collapse. Oversight could limit excessive leverage, enforce transparency on valuations and risks, and ensure that pension funds and public money aren't overexposed. Without regulation, hype-driven capital can spiral out of control, leaving the economy vulnerable to sudden shocks. Smart, proactive policies won't stifle innovation, they'll stabilize the market, protect investors, and reduce the chances of a systemic crisis when reality catches up with the hype.
No, governments should not regulate AI investments to prevent a bubble collapse, as such interventions risk stifling innovation in a fundamentals-driven sector. Echoing warnings that overregulation could kill the next tech revolution. AI's $340 billion 2025 capex fuels real productivity 1.5% TFP boost by 2035, not speculation, with existing financial oversight. FSB framework sufficient. Direct curbs won't happen, as casino capitalism protects private bets instead. Prepare without bailouts. Regulations slow breakthroughs, per experts, harming $3.5 trillion growth. Let markets self-correct for enduring value.
Should policymakers fund foundational AI research to stabilize the sector?
Absolutely. Policymakers should fund foundational AI research to provide stability and reduce reliance on hype-driven private investment. Public funding can focus on long-term, high-impact projects that aren't immediately profitable, lowering pressure for startups to overpromise and overvalue. It also ensures that AI development benefits society broadly, not just a few dominant firms or investors. By supporting rigorous, foundational work, governments can help the sector grow sustainably, mitigate bubble risk, and maintain innovation even if speculative funding dries up. This kind of strategic investment is a safety net for the entire ecosystem.
Yes, policymakers should massively fund foundational AI research to stabilize the sector, not to prop up valuations, but to secure compute independence, open models, and national competitiveness. Private capital dominates $342 billion 2025 capex, yet foundational breakthroughs, scaling laws, architectures are public goods. U.S. Public AI R&D lags China 10-1 in spend, open source lags closed labs 6 to 18 months. DARPA-style programs birthed the Internet Chips Act, already delivered TSMC fabs. A $100 billion plus public moonshot. G. National compute clusters, open grok scale models hedges NVIDIA OpenAI concentration, lowers costs for startups, SMEs, and prevents winner-take-all fragility. This stabilizes the $3.5 trillion ecosystem without picking private winners of pure infrastructure play.
Could diversification into non-AI technologies protect against crisis?
Absolutely. Diversifying into non-AI technologies is one of the best ways to shield companies and investors from a potential AI-driven crisis. If AI valuations collapse or hype fades, firms with broader tech portfolios, cloud, semiconductors, renewable energy, biotech won't be left entirely exposed. Diversification reduces systemic risk, smooths cash flow, and ensures that innovation and returns aren't tied to a single, overheated sector. Betting everything on AI is like putting all your eggs in a bubble. Spreading investment across multiple areas makes the ecosystem far more resilient when the inevitable correction hits.
No, diversification into non-AI tech won't meaningfully protect against a crisis because AI is the core general-purpose driver of the next decade, like electricity in the 1920s or the internet in the 1990s. Non-AI sectors: quantum, biotech, fusion, robotics all ride AI's rails. AlphaFold accelerated drug discovery 100 times. Optimus needs grok-level vision. Fusion control runs on real-time ML. Global R&D shows 68% of breakthrough patents now cite AI methods. Betting against AI is betting against physics-based productivity gains that lift every industry. A true AI correction would drag everything: energy, chips, cloud, manufacturing, while non-AI plays remain derivative and smaller to $100 billion, a $500 billion markets versus AI's $3.5 trillion trajectory. The only real hedge is deeper AI exposure, open models, efficient inference, domestic compute, and not fleeing the revolution.
What balanced strategy could reduce bubble risk without slowing progress?
A balanced strategy would combine realistic expectations, disciplined investment, and targeted public support. Companies and investors need to focus on fundamentals: profitability, measurable adoption, and technical feasibility rather than chasing hype. Governments can fund foundational research and set clear regulations to prevent overexposure and reckless leverage. At the same time, firms can diversify into complementary technologies and manage risk across their portfolios. Education, workforce planning, and gradual integration of AI can align adoption with real-world capacity. This approach slows speculative excess without stifling innovation, letting AI progress sustainably while reducing the likelihood of a catastrophic bubble burst.
A balanced strategy to mitigate perceived AI bubble risks without stifling progress. Blend governance, diversification, and value focus. For firms, implement AI FinOps for cost visibility and controls, curbing shadow spend while enabling experimentation, boosting ROI 3.7x. Deploy mature solutions, learn from pilots, and prioritize efficiency or security over hype. Investors, diversify across AI infra apps, demand metrics on moats returns, avoiding quick flips. Policy, fund open foundational R&D $100 billion plus public clusters, build trust via guardrails accelerating inclusive growth. This sustains the $3.5 trillion boom responsibly.